So just to help them, I have thought of bringing this issue at the forum of through a particular forum, and this is the Lexfavios has provided me a forum. I'm thankful to Mr. Sumesh and the firm which has brought me to this forum for sharing of my ideas with the housing finance companies and the NBFCs. And this is, I think, is a topical subject. It is everybody's mind at various levels, basically compliance and the functions. So I will open up, and this session is free for discussions, because it is more of a discussion, because I am not the person authority who is writing all those. So it is not a one-way communication. I would like to share your thoughts also in the group, so the entire group is benefited. And later on we can have design some other follow-ups also to get those processes implemented also through this form, because this is the form which is providing a lot of consulting work. So I'll open up my topic discussion over here. So first of all, what is skill-based regulation? What was the regulation earlier, and why the RBI has thought of scale-based regulation? So why this? So because we have seen some turmoil in the NBFC segment in the year 2019 and afterwards also. So idea was that to provide, it is not the one suits fits to all. It's not something. So because there are various segments, various kinds of housing finance companies. Basically, I'm addressing this session for the benefit of HFCs, but it is applicable to NBFCs also. So idea is to because in the sector that you have many HFCs of various segments they are in at various size activities also. So idea is to have a regulatory framework to meet the changing risk profile of the NBFCs. You will surprise that the NBFC segment has blown up like anything. The share of the NBFC to the bank's AUM is nearly 25% as of 2020 figures, and now for the last 5 years, it has doubled. The NBFC's AUM has doubled in the last 5 years. So it is growing, and they have entering into many areas of the banking NBFC segment. So idea is to have the, because of the, so with this, there is a risk profile which is getting changed, basically the bigger HFCs, bigger NBFCs. So earlier the concept of linked to systemic risk contribution of NBFCs, because some of the HFCs, NBFC which are more than 500 crores AUM, they are considered to be systemic, and they have a different rules book based on principle of proportionality. Of the idea is that to have the regulatory framework which is suiting to their risk profile. So why to impose higher risk, stringent risk measure, regulatory measures to a company which is very domestically and the domestic market and not having other than the housing finance, and calibrated regulatory and supervisory measures. So here with this scale-based regulation, your HFC's engagement with the supervisors will be more. Their role is coming more important in this new frame of regulations. I will let you know how it is coming. It is less rigorous because it is not to burden the compliances to the smaller companies or the medium-sized companies. So rigorous regulatory framework to provide operational flexibility to promote growth and fair competition. You will find, if you see the history of the regulatory framework for last decade or so, gradually the regulatory measures have been left to the company itself. Many of the relaxations have been provided. It has been self-regulatory. Idea is to have a self-regulatory system. So many of the regulatory measures, supervisory measures have been left to the board of the company. So deregulating the process so that it should not become stringent, and the company should have the arm space to move on and have a fair competition in the market. Because market itself is a regulator, a kind of regulator for the company in the financial sector, because market has told us a lot of stories. Moving towards holistic views to assess the overall health of NBFC. So idea is to have a complete, it's a body checkup, complete body checkup instead of checking one arm, one organ, and all those things. So that's a approach. I can conceive what is coming out from the scale-based regulation. You can interrupt in between also, because I am not leaving the subject. So in between also you can interrupt, because I want a participative discussion. So what is scale-based regulation now? It is a 4-layer based. Its approach is 4-layer based on their size, activity, and perceived risk. The lowest layer is called the NBFC BL, base layer. Middle layer and the upper layer is known as NBFC middle layer and NBFC upper layer. Top layer is, it is said it's to be expected to be kept empty. There will be no companies in the top layer. It will be on the supervisory review, and as per the RBI, the perceived risk of the company, they will be brought in under the top layer. So basically there will be 3 layers, lower, middle, and the upper layer. All the housing finance companies shall necessarily fall into middle layer. HFCs may fall into UL depending upon supervisory review, and there are some parametric model is given, methodology to how to evaluate and gauge the perceived risk of the company to put into various layers. So the company would be brought into the upper layer based on the parametric score of potential risk. So there is a certain minimum threshold. If you are within that, you will remain in middle. If you go above the threshold level, so the RBI may ask you to move to the UL. So there will be a different approach on regulation. So regulatory standards meant for the base year NBFCs shall remain applicable to NBFCs falling into higher layers. So what is minimum is regulatory standards for the base year? That will be applicable to higher layers also, but not the vice versa. So naturally, all NBFC ND shall be referred. Now the classification has changed now. Earlier we have systemic, non-systemic like that. So here it is said that all NBFC ND, NBFC non-deposit taking, shall be referred to a NBFC BL, and NBFC deposit and NBFC ND SI, means systemic important companies, to be labeled as NBFC ML and NBFC UL as the case may be. So this is the classification which is going to unfold before us, and these all new regulations will be applicable from October 2022. So it is just a preparatory session for you. What is base layer? So all non-deposit taking companies, NBFCs, with the asset size of 1,000 crores and less. So they all come under base layer, or other type of companies who do not have any customer interface or the business kind of thing. Say NBFC P2P, NBFC account aggregator, non-operative financial holding company, NBFC is not availing any public funds and not having any customer interface. So there are, various kinds of NBFC. There are P2P companies, AA companies, a non-operative financial holding company, which is there to provide the financing to the segment or the subsidiaries. So these are the companies which will fall into the base layer. Next, the middle layer. So here all deposit taking NBFCs, means the HFCs also, irrespective of asset size. Whatever, if you are taking deposit, you are falling in middle layer. Non-deposit taking NBFCs with asset size of 100 crores, 1,000 crores and above. So less than 1,000 crores fall into BL, and 1,000 crores and above will fall into middle layer. NBFC undertaking the following activities. So standalone primary dealers, because some of the NBFCs work as standalone primary dealers. Infrastructure debt fund NBFCs, core investment companies, housing finance companies, and infrastructure finance companies. So as I said beginning, and HFCs will fall into middle layer. Is it okay? Am I too fast or too slow? Something like that? You can comment on me about my delivery so that it should be on page. If you're not comfortable.
No, sir, it's fine. Yeah.
Okay, fine. What is upper layer is that the upper layer shall comprise of those NBFCs which are specifically identified by the Reserve Bank. So RBI is there to identify which company should come under upper layer, warranting the companies which are required enhanced regulatory environment requirement based on set of parameters. As I've said, there is a parametric model methodology to evaluate, and then if you are falling above the threshold, you will fall into upper layer. So top 10 eligible NBFCs in terms of their asset size shall always reside in the upper layer, irrespective of any other factor. So it is pre-decided that top 10 NBFCs will fall in upper layer. There's a space for 50 companies. So excluding these top 10 eligible, so there will be always 50 plus 10 companies under the upper layer. Other NBFCs having higher than threshold parametric score shall be put under top layer and shall remain there once their score comes to, even if you are falling below in a particular year, you are falling below the minimum level of score, but you have to maintain it for next 5 years to move to the middle layer. So once you are there in upper layer, you will continue to be in the upper layer, even though your score is below a threshold. Movement from UL to ML subject to RBI approval and following supervisory review. So as I have said in the beginning, there will be more supervisory engagement. So NHB's role is going to be more important and more, cohesive, rather close, rather than having inspection done and once in a year and gone. It will be a continuous dialogue. It will be a consultation kind of thing. So it's a kind of hand-holding which is going to come. Top layer will ideally remain empty. As I said, this layer can get populated if the Reserve Bank is of the opinion that there is a substantial increase in potential systemic risk from specific NBFCs in the upper layer. And such NBFCs shall move to top layer from the upper layer. So they will move from upper layer to the top layer. Otherwise, top layer will be empty. So this is what all about the classification. New classification under the scale-based regulation. I move on now to the other subjects. What are the changes which is coming into effect now with this scale-based? So first change is every company now NBFC. Earlier they were having 2 crores, 5 crores NOF. Now every company has to have a 20 crores minimum regulatory capital by March 31st, 2027. But there is no change in HFC's minimum requirement is 20 crores. That is not going to change. It will remain. But there is a phase period timeline that those who are not having 20 crores, they have to achieve by March 31st, 2023. So this was earlier. There's no now not coming from any new regulation. NPA classification in some of the companies there were not 90 days. In other HFCs are following 90 days. There is no change for the HFCs. But other companies, other NBFC segments which are having 180 days or all those. So everyone has to come into 90 days overdue norms for classification of NPA. And this position they have to reach by March 31st, 2026. Now, the scale-based regulation expect the board to be more professional. Basically, in a small company, family-based business, or all those. So they want the board to be more experienced. At least one of the directors shall have relevant experience of having worked in bank and NBFC. There is a restriction for independent directors to be in the board of NBFCs. So they say not more than 3 NBFCs an independent director can be a member, which are falling in middle and upper layer. Though they can be, he and she can be a member of the board in the base layer company NBFC, but in the middle and upper layer, maximum 3 companies he can hold the position. And if there are any, this position is to be obtained, reached by 2 years from October 1, 2022. So this is the timeline which they have provided, this board level change. If the board is not having any finance person, they should have it. If the independent directors are having more than 3 NBFCs members, they should leave one and get this harmonized. Ceiling on IPO. Some of the NBFCs have given permission, they can finance the IPO So there is a ceiling that not more than 1 crores per borrower. So, but NBFCs on a conservative basis can fix a lower limits also. Then there is a requirement for having an internal capital adequacy assessment process. You know, you have a CRAR calculations, capital adequacy process, how to evaluate how to determine the NOF and how to determine the capital adequacy. That is the regulatory capital. So in the scale-based regulation, there's a flexibility because that is the minimum everyone has to maintain. But a certain above level, if you are if you have a riskier proposition, you have a more risky asset size, asset class, then you need to have a higher level of capital adequacy. So, and if you are, but minimum level is threshold. So it is expected that the company should have a little more. So how will you determine your internal capital adequacy? That's a that's a system you have to bring in the NBFC, having a board approved policy first. The objective of ICAP is to ensure availability of adequate capital to support all risks in business. So you have to identify all the risk credit, whatever be type of risk, you know it better. And you have to identify in a very detailed manner and then quantify and have a system approved by board to assess your what is the requirement for your capital. Uh, Use better internal risk management techniques for monitoring and managing their risk. Internal capital assessment shall factor in credit risk, market risk, operational risk, and all other residual risk as per methodology to be determined. Uh, this is to be done on a similar lines as ICAP for the Pillar 2 arrangement for the banks. So banks are expected to follow the Basel III capital regulations, which is a RBI circular of July 1, 2015. There is a Pillar 1, Pillar 2, and Pillar 3 approach. So they have to follow the Pillar 2 approach, and it is the timeline has already passed, and the banks are on in the Pillar 2 approach they are following. But in the NBFC sector, you have to have your internal mechanism in lines with the Pillar 2, what is described over there. But you will not be insisted to maintain the capital as per Pillar 2 requirement. So that's a difference. This will facilitate an active dialogue between the supervisors and NBFC for the assessment of risk and monitoring as well as mitigation of the same. So that's the approach that is we have to go with for the having a system of your ICAP. And this is a timeline for that. It's not something which you have to rush in. Guidelines for supervisory review process of RBI and the ICAP of the bank. This I have brought in from the Basel agreement. So Basel capital adequacy framework rests on the following three mutually reinforcing pillars. One is the minimum capital requirement, pillar 1, which we have. Supervisory review process, where the inadequacies in the supervisory review process is to be overcome by this approach, which envisages the establishment of suitable risk management system in HFCs and their review by the supervisory authority. Then pillar 3 is the market discipline. So market discipline is what we mean is which seeks to achieve increased transparency through expanded disclosure requirements for banks. So you will see that you will have to make a more disclosures in your annual accounts when you move on to the scale-based regulations. So this is the pillar 1, pillar 2, and pillar 3 approach. We are already on pillar 1, but pillar 2 and pillar 3 we have to gradually move on. So because many of the companies, they are seeking funds from the market, from domestic as well as international. You are going for IPO, you are going for public issues. So there are various kinds of stakeholders, public investments and private investments, and international funds are coming, FID, foreign direct investment. So there are various ways. So to work in that environment in a sustainable manner and to compete with the companies internationally, this is required. This is not something RBI, it is an intergovernmental process. It is an entire global system is to stand on these principles, and which RBI is trying to bring in for the NBFCs now. What is supervisory approach? I just a few lines I will describe. Requires NBFC to implement an internal process called ICAP for assessing their capital adequacy in relation to their risk profiles. Suppose you have a class of assets where the risk is more, say restructured class, or you have acquired the assets somewhere, or you have a more on corporate funding or the bridge loan or kind of thing. So you accordingly you have to put them risk as well as strategy for maintaining their capital levels. So it is not the one capital requirement for all. You have to identify your own capital requirement and appropriate identification and measurement. You have to have this system of identification and measurement of risk and appropriate level of internal capital in relation to NBFC's risk profile, application and further development of suitable risk management systems. Because your risk management system I have seen in some other companies is very bad. Yeah. So RBI has brought in the liquidity risk management system and the coverage ratio. So, and if you go into details of the liquidity risk management system, there is lot many things. Your ALM has been fine tuned. RBI has said to have a stock approach, trading approach, have it develop ratios and like that. So suitably you have to amend your risk management policy and the ALM policy to move on to this position. Next is additional capital guidelines regarding NBFC UL. Now moving on to the NBFC UL, what is specific guidelines, additional guidelines which are applicable, would be applicable. First of all, they have to maintain a common equity tier 1 capital of 9%. Leverage a suitable ceiling to be provided besides minimum level of CRR. Every company has to have a minimum level of CRR. Besides that, they have to provide the leverage, how much they can have. Differentiated standard asset provisioning. You have a standard asset provisioning as per regulator 0.25%, 0.4%, 0.75 and 1% depending upon the class of assets. But you can have it, RBI has allowed you to have a differentiated standard asset provisioning, maintaining the minimum requirement as per the regulatory norms. Large exposure framework. So you can have a higher standard asset provisioning if you have a very riskier assets, but they are standard, but you perceive to be risky. You can put on higher standard asset provisioning. Large exposure framework, they have come out with the guidelines. Yeah, RBI will provide a guidelines. Guidelines are not there. Internal exposure limits, board approved sector specific internal guidelines. Then qualification of board members, experts in the field that want the board to be more professional. Listing requirement. Once you move in UL category, you have to get your stocks listed. If you are not listed so far, it's a private limited company, and if you're classified as UL, so within 3 years you have to get your stocks listed, shares listed. So that's a mandatory requirement going to come. Removal of independent director. If you are removing any independent director or independent director is resignation or whatever before completion of terms of appointment, that is to be reported to supervisors. And higher capital charge, that if the RBI decides to maintain a higher capital, then you have to maintain. So that will depend upon the communication from the RBI. So the other changes, which is for the UL, there is a transition plan for NBFC UL RBI has provided. So what they have said, RBI will notify the company that, okay, based on your supervisory reports and all those things, RBI is advising you to notifying you in the UL category. So once you get that notification, within 3 months of being advised by RBI regarding its inclusion in UL, the NBFC shall put in place a board approved policy. So this is the first step you have to do. Once you are notified UL, then you have to bring out the board approved policy within 3 months. Adoption of where what the policy will say, how you are going to enhance the regulatory framework, the minimum, maintaining minimum and bringing out more from your internal systems, regulatory framework, and chart out an implementation plan so that the board will approve what are the regulatory framework additional you have going to bring in and what's the time plane. The board shall ensure that stipulation prescribed by NBFCUL are adhered to within a maximum time period of 24 months. So from the date of advice regarding classification of fuel from RBI. So within the 24 months is the given time where you have to get everything implemented. During the period of transition, there will be a calibrated increment to business. So you will not be allowed to jump on business as you wish, because RBI will be providing you a calibrated increment, allow you to how much you can do to business, maybe through supervisory engagement. So that will be limited now. As you have seen in the banks, when the banks are brought under any kind of restrictions, so certain activities are, either they are paused or they are banned. So likewise here, they are not stopping you to do business, but there will be a calibration. Your business will be seen by the supervisor. The period of 3 months provided for charting out the plan for implementation. The 3 months is subsumed in the 24 months. So total time is 24 months. The roadmap as approved by the board towards implementation of enhanced regulatory framework shall be submitted to RBI and shall be subject to supervisory review. So that's the transition plan once you are notified as UL. Okay. So there are certain changes which are in the nature of prudential guidelines which are applicable to NBFC, ML, and UL. So what are those? So earlier we were having the separate limits of exposure, credit and investment separate, 15% and together 25%. And so here the credit and investments have been, the exposure limits have been merged. So to 25% for single borrower and 40% for single group of borrowers or parties. And this limit is to be, earlier we have to work out based on a net owned fund. Now you have to work on tier 1 capital. So tier 1 capital will be the basis for determining how much you can expose yourself to a single party and a group of borrowers, and within a limit of 25% and 40%. So that's the change. Sensitive sector exposure includes capital market exposure and real estate exposure, and that will be internally decided. There is a regulatory guidelines for HFCs that is not going to change. There is no change in your sector exposure, capital market and real estate. But you can, RBI has said you can bring out, if you have some riskier propositions, you can have your internal limits also. Board approved internal limits for SSC separately for capital market commercial real estates within the given regulatory framework ceilings. You have 40% exposure capital market, 20% direct, 20% indirect, like that. But within that, you can have your board approved limits for specific exposure. Internal sub limits also for if you are doing IPO funding or commercial real estate, so you can have your internal limits. Housing finance company shall continue to follow specific regulation on sensitive sector exposure as are currently applicable. So there's no change on your regulatory prescriptions, but they have expected to have your internal limits, board approved limits for any segment or exposure which you think is going to be risky, because they are all having to be capital charged. There are certain changes which are of nature of corporate governance applicable to NBFC, ML, and UL. So what are those changes? One is the key managerial person. They should not hold any office, including directorship, in any other NBFC, ML, or NBFC, UL. I think it is not, commonly it is not, but if there is any person holding PMP in one company, cannot hold directorship even in NBFC, ML, or UL. A timeline of 2 years is provided with effect from October 122 to ensure compliance with these norms. There are certain additional disclosures are there to be provided with effect from March 31st, 2023. When you are going to finalize your accounts and come out with the annual report for March 31st, 2023, these are the additional disclosures which you have to make in your accounts. One is the corporate governance report containing composition and category of directors, shareholding of non-executive directors. So you have to bring in disclosure on modified opinion. If your statutory auditor is having some modified opinion, so that is to be brought in the disclosure. Then items of income and expenditure of exceptional nature. Besides your regular income, if you have any income or expenditure of exceptional nature, suppose you are doing securitization, assignment or something, or you are selling the assets and the income is taken in your account in a particular year, they are of exceptional nature, you have to bring out in the disclosure. I think we are doing that. As my experience goes, we are already doing that, but now it has been made in the compulsory. Breaches in terms of covenants in respect of loans availed by NBFCs. If you are borrowing from banks or anything, they are putting up some covenants, and if there are any breaches, it is being monitored by ALCO or the committee level. If there are any breaches, that is to be brought out in your disclosure. Suppose they say you have to maintain certain level of asset level, and somewhere you are not missed out that particular level, or some of the banks, they say you have to maintain the GNPA level of 4%, and if you are 4.5%, they are breaching that covenant of borrowing, and then you have to bring out, you have to normalize, take the corrective action, and bring out in your annual report also. So a divergence in asset classification and provisioning. If you are below a threshold level, above a threshold level, the threshold level is defined by RBI in a regulatory framework. You have to maintain certain level of provisioning, asset classification. But if there is a divergence, suppose supervisor says no, your NOF is not correct, or your NPA provisions are not adequate, and they are bringing out, so that difference is to be brought out in your divergence, is to be brought out in your disclosure once they are everything is settled out. There is a requirement for chief compliance officer. Idea is to have an independent function, compliance as an independent function than any other business verticals, and the compliance officer should be of a little senior level, and he can approach to the board and all those things. So he is a person, and they have come out with the guidelines also. So you can bring it to the board. What are the RBI guidelines, and then come out with a policy, board approved policy. Latest by April 123 by UL, and October 123 by the ML. So you have to bring that system of compliance under chief compliance officer appointment, etc. by October 123. Next is again certain corporate governance applicable to ML and UL. What it says is that compensation guidelines to remove misalignment with excessive risk-taking positions. There are certain positions, chief risk officer or treasury function, who is taking, so you should have adequate person, talented person, expert person. So your alignment should match with the position. So if you have certain positions, you should provide that kind of to bring that talent from the market. So it is not something common. He should get something more in the form of variable pay if the person is taking risk. So constitution of remuneration committee, first of all, there is a nomination and remuneration committee, the board level is there, but it's what the changes is you should have a separate remuneration committee of the board or the executives. Principle, you should have a principle for fixed and variable pay structure as defined in section 251 of the Companies Act. So they have referred. So please see that you are having the pay and variable pay structure as per that section. And malus and clawback provisions, you can whatever the extras you have given, if you're not performing or resigning or something, you can claw back or you can provide. So that provision is also, these are all rules over there in Companies Act. So accordingly, you have to frame your pay and remuneration formula. Nomination and Remuneration Committee shall ensure that there is no conflict of interest. Other governance matter to include board to delineate the role of various committees. Somewhere even my experience goes the messed up. There is no clarity on what ALCO is to do, what risk management is to do, and what the credit is to do. So you have to clearly lay out your policies for the risk management, ALM, ALCO, based on the new guidelines, new directions, and role on activities enshrined over there, and have a calendar of reviews also. There has to have a whistleblower mechanism for directors and employees to report genuine concerns. So some of the things we have, wherever we do not have, and is required to be bring in those changes, that's to be brought in. Okay. There's a requirement for core financial service solutions. So that's also coming up under the new regime of scale-based regulation. It is likewise CBS core banking solution for the bank. So RBI has come out with these guidelines also, what is core financial services, because there was a confusion how we can bring it the CBS, which is for the banks. They are accepting deposit, they are having saving account, current account. So they have brought some clarity. What is CFS and where it is applicable is that applicable to NBFCs falling in middle and upper layer with 10 or more fixed point service delivery units. If you have more than 10 or more branches, service delivery, customer service means the branches. As on October 1, 2022, then you have to have this CFS. So if you have any of the companies, the majority of the companies are having more than 10 branches, so they have to have this CFS system. CFS shall provide, what is CFS is that provide for seamless customer interface. So now we are moving in a digital platform. Many of the companies have moved in. You have a marketing channel, digital payment system, and digital currency, and the recovery mechanism, and also you have mobile apps also. You have applications also. Various API system is there. You are collaborating with the fintech companies also in helping out your business moving out. So these are the many things of many changes are happening. So what is expected in CFS is that there has to be seamless customer interface. So when if you allow the customers, so it should be like banking. You are doing the banking, you can have varied menus are open over there, whether customer service, borrowing or lending or any kind of this thing, investments. So likewise, it's seamless without any interruption. And transactions relating to product and services with anywhere, anytime facility. It's not something visiting the branch or something. So that's the ultimate we have to reach. Enable integration of NBFC's functions. So that's with the financial system. Provide centralized database and accounting reports. So it is not Excel based or old system of convention of accounting. You have to have a centralized database which have all the branches network over there, and rather you have a ERP system. You should have ERP so that that data is directly coming from the business, transaction based. It is a transaction based accounting. You should have be able to generate suitable MIS both for internal purpose and regulatory. That's the area which is totally grossly neglected. MIS, I have seen people are working on separate Excel sheet. Data is not updated. So what is to be discussed in the ALCO, and you can get the idea about how good. So idea is to have it generate a suitable MIS both for internal purpose and regulatory reporting. Many of the supervisory returns are now going to be transaction based. So it is not the fixed point of data. So they want your timeline and the live data for the purpose of regulation. So that's the requirement going to be. Core financial services timeline has been provided, and we have say middle and upper layer with 10 or more fixed point service for branches. They have to achieve this core financial solutions within the company by September 30, 2025. However, NBFC UL, who are falling in notified as UL, shall ensure that 70% of your services are brought in by under CFS system by September 30, 2024. So otherwise, if you are not in UL, then you can achieve this by September 30, 2025. NBFC base layer and NBFC middle and upper layer with fewer than 10 fixed point services. So that is not mandatory. CFS is not mandatory. The companies which are having less than 10 branches. but they are expected to move on to the CFS system by their own. Quarterly progress on implementation of CFS along with various milestones, because you have to have it's a big exercise. So you have to have a board approval roadmap for how to milestones approved by the board. And the report is to quarterly basis to be given to the RBI, how we are moving on to this system. So shall be furnished to NBFC, to the Senior Supervisory Manager, Office of Reserve Bank, starting from March 31st, 2023. So they have enough time. You can start working on that. Get yourself, seasoned and familiar with the system, and you have to find out what is today, what the system you have today, and what's the system that you want to be, say, by that time, and what are the gaps. So that the gaps would be filled by, by designing a new structure in the system, by bringing out new IT systems, controls, and like that. So it's a piecemeal. You have to the big activity, you have to break it into smaller activities and then try to achieve smaller activities, action plans. So that way you can get a big picture. Okay. There are certain regulatory changes which are applicable to NBFC, ML, and UL. One is the regulatory restriction on loans given to directors, their relatives, to entities where directors or their relatives have major shareholding. Loans and advances to senior officers of the NBFC. Ensure if you are lending in a project, so you must ensure that that's not a new position. It is always earlier also. So what we have insisted that you can sanction, but you should not disburse unless until you get an approval. That's a local body, state government or whoever be that, approval of the project. So that's there. So you must have a policy if you are giving loans to directors, or you happen to give loan to directors, relatives, or the entities where the directors have the major shareholding. So better you get a separate policy for that, how you are going to do about it. And for loan advances to senior officers, say key managerial persons. So if you have a policy or a separate scheme for that. There are certain governance guidelines which are applicable to BL. If the company falling in BL, and they should have a risk management committee. If they are not, you should have disclosures as required, and a loan to directors, you should have a board approved policy for that. Now I move just to further explain what is parametric methodology for categorizing the companies into middle and the upper layer. So as I've said, the top 50 NBFCs, excluding top 10 NBFCs, based on asset size, will fall in upper layer based on their total exposure, including credit equivalents of balance sheet exposure. So idea is that the bigger companies, they have more interconnectedness within the company and the rest of the financial system also, because you are borrowing, your investment and all those things, you have the short term, long term. So that's the idea. And if you have a more interconnectedness with the rest of the financial system, banks or mutual funds or things, then you are going to fall in that. NBFCs designated as UL in the previous year will fall in UL. If you are already notified, next year also you will remain there. NBFC added to the set by supervisors using supervisory judgment. If the supervisor is of the view that you have a higher level of risk, so then you can move. What are the components of parametric analysis is to include size and leverage. So on and off balance sheet exposure and leverage, total debt to total equity ratio. If you are high on that, you would have better chance to be in UL. Interconnectedness means intra-financial system assets and liabilities. So if you look at the various components of assets and liabilities which have interconnectedness with the rest of the financial system, suppose you have investment, mutual funds, like that on the asset side and liability side. So you are better going to be complexity in OTC derivatives. So if you have on over-the-counter derivative component, counterparty or bilateral also, you are settling the derivatives through counterparty or bilateral. that's increase the complexity on the operations, and we are better to be on the upper layer. Other components includes nature and type of liabilities, means including the degree of reliance on short-term funding. So how much you are relying on short-term fundings, liquid asset ratios, callable debt as a fraction of total debts. If you have a callable debt, if a higher level than of the total debt, or asset-backed funding versus other funding. So if you have other funding ratios is higher than asset-based funding, so they are going to be move on higher risk level. Borrowing is split by type. Say if you have a borrowing by secured debt securities, subordinated debt securities, preferred shares, CCPs, CPs, unsecured debt, securitization. So they are the kind of as borrowings which are considered to be a risky market based, because once the market moves in and down, you are prone to market risk of that kind of borrowings. So then you are better to be placed on a higher risk level. Group structure. Many of the companies, they have a large amalgamate of the group structure. They are in various business lines, and there are various layers of, within that a small company, HDFC or HFCs, they are as a subsidiary of that big group. So if you have that multiple layers, then you are having a better, higher risk. Segment penetration. If you are, because now HFC started moving in the SME sector and affordable segment, then lower levels from the rural area, then below the urban area, so you are in smaller cities. So you are going to acquire more risk. So then your segment analysis will tell us how much risk you are going to have. That will determine the level. So all those factors will be considered under your parametric analysis, and a score will come out. On the circular attached annexure is there. If you get a chance, you can have a look on that. So that way determining the score, and if you are below the threshold level, you're okay. Otherwise, you will be UL. So now I'm coming to end of my session. This way forward approach, which I have thought how to go about it. So this is my idea. Your idea could be different. So what I suggest, you follow the timelines as prescribed by RBI in stage-wise setting up of it. RBI has already set up the timeline approach. So you have to follow that, adhere that. When they say you have to submit the board approval within, they are asking for the confirmation, so you have to do that. Follow the supervisory reviews as advice on annual financial inspections, because now supervisory reviews is going to be more important than historical reports. Have the proper board level corporate governance structure in place, so that is more important. So all the business lines and verticals should be heard, and the review should be made at the board level or the committee designated by board. Clear role responsibilities of various committees. So as I've said, they were mixing up various role and responsibilities. So nothing is clear who is to do what and what level action points. Escalation level also should be brought in. So if there is system, it should be refined. Have a sound risk management and ALM framework. So as I've said, ALM framework is going to be a heavy change, because many of ratios, behavioral cash flows, study based on historical data, your prepayment and all those are your balance transfer cases. So this is to be historically reviewed. Depending upon that, you can decide where you are going to place your cash flows or fund flows in what buckets. So that's very important. Because now you see the ALM up to 30 days, they have provided the regulatory limits, but beyond 30 days, they have deregulated. They said this is the board who's to decide. So that's the way deregulation is coming in picture with respect to your internal financial management and control. Identification and quantification of various risk factors. You should be able to clearly identify your credit risk, operational risk. Operational risk is very, even if you want to say me identify the operational risk is very difficult unless until you have a very close look. So market risk, compliance risk, sound liquidity risk management and liquidity coverage framework, which has been brought by the RBI in the last master directions. So that is to be brought in and take steps in working out this internal capital adequacy assessment process. So this is the what I think should be start working on these areas to reach to a bigger picture of the scale-based regulations. So friends, that's all from my side. Now the session is open for the discussions. I will be happy to participate with you, your ideas, and share your ideas and with the group. It will benefit for the group. So thank you so much for your patient hearing. And now you can interact now.
Yeah, thank you, Mr. Saxena, for all your inputs. The floor is now open for questions. So, yeah. Does anyone have any questions? And I will be happy to answer them.
Because I know they are all practitioners, very, practitioner by few people I know personally also. So I will expect them to open up discussions.
Yeah,
They
yeah.
know much more than me.
Absolutely. Please state your name and you can ask your questions. Yeah. The floor is open now.
Yeah.
So, Mr. Saxena, before I think I have a question for you.
Yeah.
This is Sumesh. So, what, in your view, is this a a step forward in terms of making the regulation more simplified or making, because in view of the whatever we've been seeing, Divan Housing and law of housing finance companies going through the housing finance companies have not been going through a very good phase. Or you feel that this is a welcome step in terms of a regulator trying to regulate and put some, or because it's too much of regulations for overburdening the housing finance companies. So how do you see it from a
Yeah,
regulation
actually, this
standpoint?
is the need of the time.
Yes.
Uh, it should. That's a very good time for bringing those changes, because our environment, the ecosystem is expanding.
Right.
uh, what was a system in earlier 10 years before and what is today is totally changing. We have passing through that experience. As I have said in the beginning, we are already moved in the digital world, digitized world, in the all my financial activities, financial management. And the second thing is the interconnectedness of the business. So
Right.
it's just a switch of a button and you can create a havoc in the system. So because of the interconnectedness in mobile applications and internet. So that's a because if the financial system has to stand on their own, it's a self-regulatory. I have said bringing out a self-regulatory approach rather than asking for the prescription whether I am sick or not, what medicine should I take. It's not going to be approach. It's a feel yourself and it did assess your own health like that. So that's a welcome step, as I've said. And it's a the compliance burden. When I was there in NHP, I used to say, why you are burdening the smaller companies who are not taking deposit and asking them to submit so many returns. So it has been reduced. If I have a look of the 31st December NHP circular, they have reduced some certain returns and they have kept it as per the size of the company. So it is a welcome step. That's way it's a learning. It's going to be a learning for the person who are there in the main driving seat.
Right. Thanks,
Yeah.
Mr. Saxena. Do we have anyone else?
Yes, am I audible?
Yeah.
Yeah.
Can you please state your
Yeah,
name?
just take your name. Yeah.
Yeah, good evening, sir. I'm Manish Singh Pyal, Company Secretary. Sir,
From which company?
from Adani Housing, sir. Adani
Okay.
Housing Finance Private Limited.
Mm-hmm.
Sir, do you think that any downward migration of rating by the rating agencies could reclassify the levels of the company, like from middle level, it can migrate to the upper level? Any downward classification that can attract the RBI supervision?
No, it will not be a very knee-jerk kind of thing. It will never be a knee-jerk, because what the external agencies they take into account while rating the company or their instruments for borrowing or whatever be that. So they go by your internal financials, internal control, internal systems, and so that is more important, because that is why we call it the external rating, which is based on your internal financials, internal systems, internal governance, which is being shown in the balance sheet and all those, and through interviews also, and they collect the information from the company itself. So it is a totally separate exercise. This is not going to be affected by if the company is moving. Definitely, it is not going to be a knee-jerk reaction. If the company is in a middle level, it continue to be a middle level, because you are not going to change your business line. You are very often, continue to be in housing finance, because that's a license it has been given. But it is more for the companies which are in a multi-functional roles. So it is for them. And this approach is like a ABC analysis. If you follow, if you put the regulatory mechanism like that to capture the top 10 or top 30 companies, your entire sector is quietly regulated. So I don't think this scale-based regulation is going to affect your external rating. Rather, it will be helping them, because by that you will be building up the systems, and it will be improve your rating.
Yes, yes. So what I meant to say that if our rating is downgraded,
Uh,
so will the RBI will be more attentive towards us?
no, no. This supervisory rating is different, and it is not
Okay.
mixing up with the external rating. So external rating is which is downgraded because of certain reasons. They have a rationale for that, and so you should improve on those, work on those, where why it has been downgraded, and then it will improve also. So
Okay. Thank you, sir, for
yeah.
such a wonderful session. Thank you. Yes.
So any other participant friends would like to discuss?
Hi, sir. Good evening. This is Nitin Agrari.
Nitin Holia.
Yeah. Thank you for organizing this knowledgeable share session, and
Okay.
also thank you to Sumesh. So before logging into this session, I had several queries which
Hmm.
got answered well.
Hmm.
However, one question is still left in my mind that
Hmm.
which is regarding Chief Compliance Officer.
Hmm.
So somewhere it is written in the relevant circular,
Hmm.
which was issued in I think in April,
Hmm.
which says that organization should not allow dual heading for a
Hmm.
CCO position.
Dual yeah,
So,
heading. Yeah, capping.
so
Yeah.
generally, we companies secretaries are holding a responsibility of compliances in the company.
Hmm.
So if a company secretary is appointed as CCO,
Hmm.
so will this I mean provision get triggered?
Yeah. Yeah, if you see, generally, which I have also experienced, many of the company secretaries have been asked to do the compliance functions, because
Yes.
they are doing a lot of compliance relating to Companies Act. So then other compliances also. So there is no restriction, because the picture, it is not something which is not known to the regulator or the RBI. You are making this as a in a return and statements, and it has never been objected. So I don't think the CS and compliance officer uh, position of holding both should not be, it is because it is not conflicting.
Yes.
Depending upon the company size, if you are a very big company, a group company where the CS role is very wide, so you may not be afford to have compliance with the same person. But if a smaller company, where the CS functions are not as big as they are in other companies, so this can vary, because it's a similar kind of position, not conflicting. So I don't think it's going to be changed. This will continue unless until they are bringing out this clarification that yes, you should have CS separate and compliance function separate.
Okay, agreed. So another question which is still in my mind, which is regarding CFSS. So, like ours is a housing finance company where we
Mm,
are into
mm,
affordable housing finance business,
mm, mm, mm,
and our customer is not very tech savvy. They are not using
mm,
internet so frequent,
mm,
and I think net banking is not possible. I mean, functions for
mm,
us.
mm.
So, is net banking like uh, system criteria is essential for CFSS, or whatever we are currently doing is?
No, not necessarily. I am not asking the, even the circular. If you read the circular, there is no rushing in of activities. They have given us
Mm,
sufficient time. And what the basic principle of CFS is that your customer should be customer friendly, and this all your services should be available uh, uh, through the digital phase. So that's the idea. Suppose you have a mobile application, so if he wants to have that, so that should be made. So all your product and services should be made available where he should be comfortable in having that kind of services, obtaining the services from the anywhere place, anywhere and anywhere, anytime place. So suppose I want my bank statement. Suppose I want to see my loan statement. So
mm,
am I? It should not be a situation that I am going visiting your branch and asking for you. Then you say, "Saab, आप तो कल आइएगा, परसों आइएगा." So that
mm.
situation, it should be digitally available. So those, at least those minimum effort should be made so that your product and services are made available to the customer. Uh,
Okay.
that's the idea. So it is a, phasing. You have to uh, gradually you have to reach that until the sufficient time has been given. I'm not asking net banking should be made compulsory.
Mm. Understood. Thank you,
Yeah,
sir.
so there has to be a
This is all.
roadmap: step one, step two, step three, like that, depending upon your business activity and the clientele.
Okay, sir.
Yes. Any
Hello.
more?
Yes, sir.
Yeah,
Hello. Sir,
yeah,
Manish again. Manish from Adani Housing, sir.
yeah. Manish, tell me.
Sir, Companies Act permits the company secretary to be a company secretary of the subsidiary company as well. So,
Uh,
if the company secretary is a company secretary in the holding company, then he can
uh,
act as a company secretary in its subsidiary as well.
right.
So now here, after this provision, as a KMP, if we are saying that the KMP, they will not
Hmm.
act in two
Hmm.
companies. So
Hmm.
every company will have its own KMP.
Hmm.
That is one thing which is that so? Whether it
Hmm.
will override the Companies Act, the directions.
No, it will not going to override the Companies Act, because no regulation would be no take be there to overwriting any of the, because the existing laws and the act provisions will remain applicable unless until there's a modification in those laws. So if
Okay,
the
so
Companies Act allows the in a group company, the CS can be in a group, in a holding and as well as in a subsidiary, and if it is allowed, it's okay.
okay,
So regulation is not prohibiting, because the act is more important, and regulation is a supporting the act implementation. If the act is otherwise, then that is more important, and you can continue with that if the act is permitting that.
yes. Okay, so maybe some more clarification will come in the future.
Yeah, maybe, maybe.
Yes. Okay. Thank you, sir. Thank you.
Yeah. Any more questions? You can pass on your queries. It's not closing the event. I mean, it's because the ongoing. I hope I will repeat this again for one or more times. So you can pass on your questions or ideas or the thoughts to at this link, where I'll be happy to reciprocate. It's a continuing dialogue, which is going to be in future. So if there is no more questions, then Subesh can. end up this session.